Hi, and welcome to Carnegie and our interview with Bergman Beving. My name is Markus Almerud. I'm an analyst here at the bank. I got with me Magnus Söderlind, who is CEO at Bergman Beving. A warm welcome.
Thank you very much.
So you released Q3 earnings this morning.
Yes.
Negative 5% organic growth, which is a step down from Q2, but you also had less working days. What does the markets look like, if you can elaborate a little bit on the market situation right now?
I think Bergman Beving is a good proxy for the Nordic construction and industrial businesses as a total, since we have 35 companies and they're exposed to different segments within those industries. And we kind of experience still a continued weak market. And if you look at the figures, macro figures, we get some indication that it's a 3% decrease during the autumn last year.
And if we continue on that track, you talk about macro indications, because you said at the call that you expect a pickup of demand during 2025. And then I know we stood here a year ago and we talked about kind of the same thing, and then that has been postponed. But are these just indications, or are there any tangible signs that we're moving in that direction?
In some segments, you can see some positive movements. In others, it's still on a stable kind of level. So yes, if there are any signs, they are upwards, but I would say it's not kind of on a broad perspective.
And is it fair to say that we're still kind of in a stable situation? It's not moved neither upwards nor downwards, but it's kind of demand-wise still stable.
Roughly.
And do we see any difference here between industrial and construction? And then I'm talking both about where we are at right now, but then also about signs looking forward.
Once again, I don't see any big difference between construction and industry. If we see the most positive indications, we see within the construction area, I would say. There are some spots in those markets that is actually picking up now, especially in those segments related to new housing building.
Okay. You also said on the call that orders kind of slowed towards the end of the year, which is also be somewhat correlating with the amount of working days, and that was a long period of holidays. Has this normalized during the beginning of the year, or was it a trend shift, you would say?
No, it was not a trend shift. I think it's normalized now after New Year.
Okay. So same more or less as we enter the new year. Looking at the margin, so you've made a tremendous margin journey. It continues to expand year on year, down a little bit quarter on quarter. We'll come back to that sequential trend, but the phase out of the unprofitable product that we've been talking about several times, it's more or less done, but is the impact there in full, would you say?
Yeah, as you said, we have been working with phasing out the low margin, high volume businesses, and we have improved the gross margin on a 3-year period of 8% units. And we are kind of in the end of that process now. So I think the margin you see now is roughly the margin, gross margin, at least you can see going forward.
So a little bit, if I look at the gross margin progression going forward, I mean, there's always more to do, right? But the big steps are kind of done, and then you will have the mix, and we'll come back to acquisitions in a second. But then you will have acquisitions coming in with a higher margin, and that will be kind of the main margin driver, and volume leverage, of course.
Yes, if you talk about the profit margin, that's correct, since we only acquire companies, with the profit margin at least at 15%, so that will increase the group average. With that said, some of those companies may not have the gross margin as we have on the group level. They can be actually a little bit lower.
Okay.
So you can't make that kind of adjustments.
So it's more on the EBIT or operational profit level because 15% is kind of the minimum level, which is higher than where you are right now. So that drives the margin. That's how I should see it. And then also coming back to the sequential movement. So I mean, I'm right that the Q3 or calendar Q4 is seasonally weak for you, and that should be the main explanation for the kind of step down in margin sequentially.
We have some extraordinary items also in this quarter that also affect the gross margin, for example, that have some effect on the profit margin as well. But yes, generally, this quarter is a little bit weaker, and then Q4 tend to be stronger.
And I mean, coming back to we touched upon this a little bit, but you've had 20 consecutive quarters of EBITA growth.
Yes.
And that is despite the pressure that you've seen on organic growth, which has been part market, but also is phasing out kind of this phasing out of low margin, high volume products. And there's also M&A in there. How should I weigh these towards each other? Which has been the most important, or is it kind of balanced?
I mean, if we look at this profit increase we present in this quarter, the majority is acquisition driven. Organically, we have done, as you said, a lot of phase out that has increased the gross margin in organically, as well as some cost reductions. So I think we have a much more solid kind of platform to start from when the market start to pick up, because I don't see that we should have any major change in the gross margin, but neither on the cost base. So I think we will have a good leverage when the market pick up organically. Then we will continue to acquire roughly on the same path we have done during the last years, going forward as well. So that would also then have a positive contribution to the profit.
Because M&A, I mean, it's a core part of your DNA.
Yes.
And you made 4 acquisitions in a quarter, of which one was quite large. And the first question on that, what's the M&A landscape like right now?
I would say it's in line with our acquisition target to acquire 50 to 80 million in profit per year. Normally, you know, in good times, there are much more companies for sales, but the competition is much more fierce. Many more buyers out in the market. In the current market, you see much fewer companies for sale, especially high quality companies, but you also see much fewer buyers, because many of the other buyers need to work on the balance sheet and work down the debt. We have a very strong balance sheet, so we can be active in acquisition, despite that the market and the interest rate is a little bit different now. So I would say it's even Steven, basically. I don't see, and I haven't seen that historically, any big difference in our ability to acquire in good times or in tougher times.
And if you look at your own balance sheet, I think you are at 2.4, 2.5, something like that, net at EBITA at the moment.
A little bit lower even.
A little bit lower. Do you have any breaking point where it's going to start to hurt you, or how far can you go?
We had said that we could temporarily go up to 3.0 roughly, but you know, the 2.5 is more like an average over time, I would say. But we are lower now, so we don't see any financial constraints in continue to acquire and invest in our companies and to give dividends. And
it wouldn't be so if you go up to 3 times, your interest cost would kind of rise significantly or something like that?
No, we will have some effects on the interest rate, but not a major effect.
Okay. And then another question on the M&A. So you did the large acquisition, 180 million krona, and added revenue from the Finnish Levypinta, that acquisition that you did just this quarter.
Yes.
And then you had one of similar size in the UK last fiscal year. And those are pretty big ones compared to what you've done in the past. Is this a coincidence, or are you actively looking for bigger targets as well?
We have communicated, and that's part of our acquisition strategy, that our sweet spot is companies with an earning of 10 to 30 million SEK per year. So that enables us to acquire companies like Levypinta that is within that range. So we have stepped up in terms of size relative to what you have seen historically.
And we should expect that to continue. That
the 10 to 30 million earnings per year is the kind of the sweet spot for our acquisitions. Yes.
Yeah. And then finally, maybe a leading question, but still, we've been on to it a little bit. But you through the phase out of low margin products is behind you. It's hurt the organic growth over time a little bit. You keep working on cost and controlling your cost base, and you were mentioning that the cost base shouldn't go up. Once volume return, you should be able to see quite good leverage on the margin.
Yes, that's my expectation. Still, the cost is, for example, including logistics cost, so that will kind of line with the top line development as such. But yes, we will have a lower cost base if the market picks up, and we don't see the necessity to build it back to where it was before.
Because you have kind of the margin target of 10%.
Yes.
And you've kind of been there in some quarters. Yes. But there is clear upside from where we are at right now.
But as we communicated in the call today, we need to get some help of the underlying market currently. We expected that, 1 year ago. I expected it to pick up summertime 2024, and now we stand here in January and we don't see that yet. So hopefully we get it here in midterm this year, but that is still to be proven.
Magnus, thanks a lot for coming here to talk to us, and thank you very much for listening.
Thank you.